Hello and welcome back to The Note, still coming to you this week from the CFA Institute's annual conference here in Seattle, Washington. Today we're going to be talking about hedge funds and in particular whether the excellent advertised returns on hedge funds are in fact all a mirage. Now that is the somewhat contentious claim of a book that's just been published by my guest today, and he should know something about it because he used to manage hedge funds. He's Simon Lack. Simon, thank you very much for joining me today.
Good to be here.
Let's start by taking a look. We've got a chart here of annual returns on hedge funds compared to stocks, bonds and T-bills going back to 1998. And rather startlingly, it turns out you'd have been better off in bonds than in hedge funds. What has been going wrong for hedge funds?
Yeah, actually treasury bills. So
right.
bonds of course did well because rates came
yes.
down, but treasury bills, the riskless asset.
Yes.
It's because investors in hedge funds made a lot of money in the 1990s. There just weren't that many of them. There weren't
right.
that many investors. And as the money came in, it turned out to be too much capital for the hedge fund industry to invest profitably. So, you know, size is the enemy of performance.
Right.
And that's turned out to be the case with hedge funds.
Okay, so their model just isn't scalable. Now you've produced a chart which is very interesting on this phenomenon as well. That in the early part of after the dot-com bust, they really did appear to be doing something quite clever. They grew in a non-correlated way while the stock market was falling. What was the key behind that performance when they managed it?
They were still small enough. They did
right.
a great job. As the dot-com bubble unraveled, they hedged, they preserved capital, they delivered uncorrelated returns, but the industry was under $500 billion.
Right.
And because it did such a good job, it attracted so much more institutional money after that. Prior to that, hedge funds were largely a private banking product for
right.
high net worth investors. Hedge fund success drew in institutional capital, and over time the industry has become, in my opinion, overcapitalized, and the results are really proving that every year.
Now, as well as being overcapitalized, there is the suggestion that hedge fund managers themselves are overcompensated. You produced this fascinating chart breaking down returns for hedge fund investors against the fees paid to hedge fund managers. How can you even justify these kinds of levels of compensation?
I mean, it's appalling. The problem is that investors very rarely negotiate fees because the nature of picking hedge funds is you select the hedge fund that you want based on all of the criteria, and fees are the last thing that you negotiate. So the investor's never in a strong position to negotiate lower fees when they basically said this is the hedge fund that I want to include. But yes, I did the analysis on that, and anybody can sort of tease the fees out from the performance. Once you know the AUM numbers for the industry and the returns, you can derive what the fees have been. And in fact, hedge funds have been fantastically profitable. It's just that those profits have almost entirely stayed within the hedge fund industry of managers
right.
and fund of funds managers.
Now, is there any way this problem is fixable? I mean, are you basically suggesting that the whole hedge fund industry in its current state is a rip-off, or are there ways in which the model, something recognizable as a hedge fund, can continue?
Well, the first thing is there are and always will be great hedge funds, and there will always be happy clients. So what I did was I analyzed what the aggregate result had been, but of course there's good and bad stories within that. So there's always going to be hedge funds that are really successful. Some of the most talented investment managers run hedge funds because that's where the money is. But I think the mistake for the investor is to pursue a diversified portfolio of hedge funds. And it works like this. If you're going to be a hedge fund investor, you need to be good at manager selection because the aggregate result has been bad. The more diverse portfolio of hedge funds you have, the more hedge funds you have, the more your portfolio will be drawn back towards the mediocrity of the aggregate.
And the fees will weigh heavier on you and you'll lose.
The fees will weigh on you, yeah, that's right.
Okay, Simon, thank you very much indeed.
Thank you, John.
Maybe there is a case to invest in hedge funds, but unfortunately you're really going to have to be sure about what you're doing and to have the confidence to back somebody you think might just win. Trying to treat it as this big, diversifying asset, it appears just isn't going to work.